Hi, I'm Wayne Blanchard. I'm a certified financial planner and a member of the Garrett Planning Network. We're going to talk about cancellation of debt and its effect on property liens. Now, cancellation of debt is a thing that over the last few years has become something that's very near and dear to everybody's heart. What is cancellation of debt? Probably maybe a little bit different than you thought. Cancellation of debt is, let's say you go out and you buy a house, or that you are in a situation where you got a credit card and you got to the point where you couldn't pay. So the holder of the debt said, okay, since you can't pay me, you owe me $10,000 on this credit card. If you'll give me $1,000 or $2,000, whatever the number is, we'll call it good. We'll say you paid me off. Now, what does that mean? And what does it mean if that was your house that you owed $100,000 on, and they said, okay, if you'll give us $50,000, or make the payments on $50,000, we'll call it even. What does that do to the lien on your property? It doesn't really affect your lien. It affects your note. And when you have a note with somebody, and the note is the actual instrument that controls the loan that's on the property. A lien is placed on your property. A lien can be for a certain amount of money, but more than anything, it says that the person that has control over this property other than you is whoever loans you the money. So they can satisfy that lien whenever they want to. They have the right to collect the full amount, but they can satisfy the lien whenever they want to. So that means that they can take the smaller amount of money, satisfy the lien, and you're okay. Now, a couple things you need to think about. Number one, if they take a reduced amount, they can go after you for what they call a deficiency judgment. What's a deficiency judgment? A deficiency judgment is when you paid them $50,000, you owed them $70,000, the deficiency is $20,000. They can come for that unless you have it written into your original agreement. By that I mean the agreement where they agreed to take the $50,000, that they would not do that. Be very careful about that. The second thing is that on things other than mortgages, and it's not on mortgages right now, because I believe through 2013, if on houses or on mortgages, if you do this, the difference, how much they forgive, is basically a taxable event. It's just like them giving you that money. So think about that. You could have a taxable income of the difference between how much you paid and how much you owed. So let's go back to the credit card, because this is where it's probably more likely going to catch you. You had a $15,000 credit card balance. You paid them $5,000. They said, okay, you're good. The next thing that happens is they file a thing to the IRS, because they have to do this on any transaction over $600, that says they gave you $10,000. That has to be showing as income on your tax return for that year. So be careful about that. Be careful about deficiency judgments. Be careful about how much you're going to have your taxes increased when you have a cancellation of debt.